Every first Friday of the month, the U.S. Bureau of Labor Statistics releases the official employment situation report. Markets pause. Traders lean forward. The Fed watches closely. And for the next 72 hours, financial media analyzes every decimal point of the number as if it were gospel. This Friday, the July jobs report arrives. After June's shocking 57th reading, less than half of what economists had projected, markets are expecting a bounce. The consensus estimate is somewhere around 130 new jobs. The number will move markets. The Fed will reference it, politicians will cite it, and almost nobody will mention what a different government data set. One that receives almost no media coverage, one that draws from actual unemployment insurance filings rather than surveys, one that has a 9-month lag but is based on hard administrative data rather than statistical models, has been showing for the past 2 years. That dataset is called the Quarterly Census of Employment and Wages, the QCEW, and what it shows is that official non-farm payroll figures were wrong by 8 standard deviations in 2045, standard deviations in 2025. The downward revisions are continuing quietly into 2046. The jobs that the Fed cited. To understand why the gap between official payroll data and QCEW data matters, it's necessary to understand precisely what each measures and why they can produce dramatically different pictures of the same underlying reality. The Bureau of Labor Statistics non-farm payroll report, the monthly jobs number that markets move on, is produced through 2 surveys. The Establishment Survey asks a sample of approximately 190,000 businesses how many people they employed in the reference week. The Household Survey asks a sample of approximately 60,000 households whether any member worked in the reference week. The BLS then uses statistical modeling to extrapolate from these samples to national employment estimates. This methodology is sound in principle and works reasonably well in normal economic conditions. But it has specific vulnerabilities that become significant in periods of economic stress or structural change. The birth-death model, the statistical adjustment the BLS uses to account for businesses that are too new to be in its survey sample or that have recently closed, is particularly vulnerable in periods when business formation and closure rates are changing rapidly. The birth-death model can significantly overstate employment by assuming new business creation is occurring at historical rates, when actual formation may be substantially lower. The Quarterly Census of Employment and Wages, by contrast, is not a survey. It is an administrative record, a near-complete count of all employment covered by unemployment insurance, drawn from the actual payroll tax filings that employers submit to state unemployment insurance agencies. It covers approximately 95% of all non-farm employment. Its primary limitation is its 9-month publication lag. The QCEW for a given quarter is released approximately 9 months after the quarter ends. But what it lacks in timeliness, it compensates for in accuracy. It is based on actual administrative records rather than statistical sampling. When the QCEW and the payroll report diverge significantly, when the payroll survey says more jobs existed than the QCEW administrative count records, the QCEW is almost always the more accurate measure. The BLS itself uses QCEW data as the basis for its annual payroll benchmark revisions, which adjust the survey-based estimates to match the administrative reality. The 2024 benchmark revision, released in early 2024, showed that official payroll figures had overstated employment by approximately 21,000 jobs for the 12 months ending March 2024. This was the largest downward revision since 2009. The 2025 data, where the QCEW figures showing 8 standard deviation divergence are drawn from, suggests the overstatement continued and potential. The phenomenon of official economic statistics diverging from economic reality is not new. It has appeared in various forms at critical moments in the history of major economies, and the historical record of what follows such divergences is specific and instructive. The most extreme historical case is the Soviet Union's economic statistics throughout its existence. Soviet central planning required production targets, and the reporting of those targets' fulfillment was itself a political act. Officials who reported underfulfillment faced consequences, while those who reported success were rewarded. The result was a systematic inflation of reported economic output that persisted for decades. Western economists, intelligence agencies, and international institutions consistently overestimated Soviet economic capacity based on official Soviet data, a misperception that contributed to both the overestimation of Soviet military capacity and the surprise with which Western observers greeted the Soviet economic collapse in the late 1940s. The Soviet case is an extreme of deliberate falsification, but less extreme versions of the same dynamic where the institutional incentives for positive economic reporting overwhelm the commitment to statistical accuracy have appeared in multiple democratic economies at moments of economic stress. Argentina's CPI statistics in the years preceding its 2000 debt default are one of the most documented cases. The Argentine government, facing a currency board peg that required domestic price stability to maintain, consistently reported inflation figures that independent economists and the IMF privately acknowledged were significantly understated. The official statistics provided cover for policies that were not working, and when the gap between official statistics and economic reality became impossible to maintain, the collapse, when it came, was both more sudden and more severe than any official projection had suggested. Greece's fiscal statistics in the years preceding its 2010 sovereign debt crisis represent another case. Greek governments had consistently reported deficit figures to Eurostat that significantly understated the actual fiscal position, reporting deficits of 3 to 5% of GDP when the actual deficit was 12 to 15%. When the new Papandreou government restated the fiscal figures in late 2009, the revelation triggered the sovereign debt crisis that nearly collapsed the Eurozone. The common thread across these cases is not deliberate fraud in most instances. It is institutional incentive misalignment. The tendency of statistical agencies under political pressure and methodological constraints to produce numbers that tell a better story than the underlying reality supports. And the common consequence, when the gap between official statistics and reality becomes large enough to be undeniable, is a rapid, violent repricing of risk assets that had been valued on the basis of the official rather than the real data. The Weimar Republic's experience with economic statistics during its hyperinflation period of 1921 to 1960s, during its hyperinflation period of 1971 to 1973, offers the most historically resonant parallel to the current divergence between official US employment data and QCEWAT administrative reality. Not because the economic conditions are directly comparable, but because the statistical dynamic is structurally identical. Weimar Germany's statistical agencies continued producing official economic data throughout the hyperinflation period: industrial production figures, employment statistics, cost of living indices. These statistics were not fabricated in the sense of deliberate falsification. They were produced through standard methodological processes that were simply unable to keep pace with the speed and scale of the economic disintegration they were attempting to measure. The result was a systematic lag between official statistical reality and lived economic reality that became increasingly pronounced as the hyperinflation accelerated. Official statistics showing continued industrial employment masked the economic reality that real wages were collapsing, that the purchasing power of those wages was destroying middle-class living standards in real time, and that the businesses reporting continued employment were increasingly operating in a monetary environment that bore no relationship to the stability their production statistics implied. The gap between official statistics and economic reality in Weimar Germany was not primarily a story of deliberate manipulation. It was a story of statistical methodology failing to capture a structural economic transition that was occurring faster than the measurement systems could track, and the people who relied on the official statistics, who made financial decisions, savings decisions, investment decisions based on the numbers rather than on the lived economic reality around them, were systematically misled about the trajectory of their economic environment until the trajectory became impossible to ignore. The QCEW divergence from official payroll data in the current American context is structurally analogous, though dramatically less extreme. Official employment statistics are systematically overstating the actual employment base based on a methodology that is not keeping pace with the structural changes in the labor market. Business closures, the gig economy's complexities, the birth-death model's limitations in a period of elevated business formation and closure volatility. The people making financial decisions, including the Federal Reserve, whose rate decisions depend on accurate labor market assessment, are potentially making those decisions based on a labor market picture that is significantly more favorable than administrative reality supports. The QCEW divergence from official payrolls is one dimension of a broader statistical reality that the K-shaped economy framing captures: the growing gap between the economic experience of the top of the income distribution and the economic experience of everyone else, a gap that aggregate statistics systematically obscure. The bottom 80% of the American income distribution is missing credit card and auto loan payments at rates that have been rising for 2 years. Foreclosure filings, while still below the peaks of 2008 to 2010, have been increasing from their post-COVID lows. Food bank usage in major American cities has been running at levels not seen since the peak of the 2000s recession. Consumer savings rates, which surged during the COVID stimulus period, have returned to their pre-COVID lows, meaning the buffer that cushioned lower-income households against economic stress has been substantially depleted. None of this is captured in the headline GDP growth rate, which reflects the average of a distribution that is increasingly bifurcated. None of it is captured in the S&P 500's performance, which reflects the economic health of the largest American companies, whose profit margins are more correlated with the top of the income distribution than with the median. None of it is captured in the official unemployment rate, which measures whether people have jobs rather than whether those jobs pay enough to maintain their economic position. The 45% of S&P 500 market capitalization that is AI or AI adjacent, the technology sector that has been the primary driver of equity market gains, reflects the economic reality of a specific sector whose performance is not representative of the broader economic experience of the majority of American households. This bifurcation between the statistical economy that headline numbers describe and the lived economy that most households experience is itself a historical signal. The 1920 economy that preceded the Great Depression produced similarly bifurcated statistics: strong aggregate GDP growth, rising stock markets, and increasing productivity alongside stagnating wages, falling farm incomes, and growing consumer debt for the majority of the population. The aggregated statistics told a story of prosperity. The distributional data told a story of structural fragility that the aggregate masked until the collapse made it impossible to ignore. The most important institutional implication of the QCE divergence from official payroll data is its impact on the Federal Reserve's policy decisions and therefore on the bond market's assessment of whether monetary policy is appropriate for the actual economic conditions rather than the official statistical ones. The Federal Reserve's rate hold decisions over the past several months have been justified in part by reference to labor market strengths. Official payroll data showing consistent monthly job creation, even with the June anomaly of 57, provided cover for the argument that the economy was strong enough to tolerate current rate levels, or that the labor market's strength was a reason to remain cautious about easing rather than aggressive about tightening. If the QCU data is accurate, if the actual employment base is significantly below the official payroll figures, the Fed's labor market assessment has been systematically too optimistic. A labor market that is weaker than official statistics suggest is also a labor market that is creating less income, less consumption, and less economic momentum than the headline figures imply. This means the inflationary dynamics the Fed is trying to address are occurring in an economy that is simultaneously weaker than it appears, closer to the stagflation trap documented in the 15th video than the robust growth with high inflation scenario that official statistics describe. The bond market's pricing in recent weeks, the 30-year Treasury at 5.2%, the aggressive sell-off following the Fed's hold decision, is consistent with a bond market that does not believe the official statistical picture. Bond market participants have access to the same QCEW data, the same credit card delinquency figures, the same consumer financial stress indicators that this video is examining. They are pricing not the official economy but the real economy, and their pricing suggests they believe the real economy is simultaneously more inflationary and more fragile than the aggregate statistics indicate. This is precisely the bond vigilante dynamic documented in the previous video, a bond market that is delivering a verdict on the credibility of the official data and the policy derived from it through the mechanism of yield increases that tighten financial conditions regardless of what the Fed decides at its official meetings. The specific historical mechanism that the QCW divergence implies, the annual benchmark revision in which the BLS adjusts survey-based payroll figures to match the administrative reality, is itself a predictable source of near-term market disruption that historical precedents help quantify. The 2025 benchmark revision, which restated 2025 employment by approximately 800 jobs, while the largest downward revision since 2009. The 2026 revision, which will incorporate the 4 to 8 standard deviation divergences that have been accumulating in 2025 data, is likely to be comparable in scale or larger. Large benchmark revisions have historically produced specific market reactions that follow a predictable pattern. In the immediate aftermath of the revision, there is a repricing of assets that had been valued on the basis of the overstated employment figures, equities whose valuations incorporated optimistic earnings growth assumptions based on strong labor markets, bonds whose yields reflected assumptions about Fed policy calibrated to the stronger official labor market, and currencies whose strength had partially reflected the perception of a robust American economy. The repricing is typically followed by a recalibration of Federal Reserve communications. The Fed is forced to acknowledge that the economic conditions it was responding to were different from what its data suggested and to adjust its policy narrative accordingly. This recalibration creates a further period of uncertainty as markets try to establish what the Fed's actual policy reaction function looks like when calibrated to the revised rather than the original data. The 2009 precedent, the most recent comparable large-scale downward revision, occurred in the context of the post-financial crisis labor market and was incorporated into a Fed policy framework that was already at the zero lower bound. The current context is more complex. The revision will arrive in an environment where the Fed is already under pressure from bond vigilantes, where inflation is above target, and where the policy implications of a weaker than reported labor market pull in opposite directions toward easing on employment grounds and away. This Friday's July jobs report arrives in the context of an earnings season that is telling its own complex story about a bifurcated economy, a story that is directly relevant to the statistical reliability question this video has been examining. SpaceX's first earnings announcement as a public company on Tuesday is the most anticipated single earnings release of the week, and its financial performance will provide a real-time test of whether the AI and technology infrastructure investment that has been driving equity market valuations is producing the returns that justify current asset prices. The broader earnings picture for Q2 is simultaneously impressive in aggregate and concerning in composition. S&P found operating EPS growth of 37% year-over-year includes substantial mark-to-market investment gains from several Magnificent Seven companies, gains that are not recurring and that excluded from the calculation would significantly reduce the headline growth rate. The concentration of earnings growth in AI and technology-adjacent companies, combined with the broader economic stress indicators documented throughout this video, is exactly the bifurcation pattern that has historically characterized late-cycle equity market dynamics. The 45% of S&P 500 market cap that is AI adjacent is pricing a future of continued AI infrastructure spending, continued productivity gains from AI deployment, and continued revenue growth from AI-enabled products and services. Some of this future will materialize. The productivity gains from AI are real if unevenly distributed. But 45% of the market cap of the largest public companies in the world is an extraordinary concentration of valuation in a single technological narrative at a moment when the broader economy's statistical foundations are being called into question. The Goldman Sachs warning on the difficulty of placing AI infrastructure debt The observation that bond market conditions are making the financing of continued AI infrastructure build-out increasingly challenging connects the equity market narrative directly to the bond market verdict documented in the previous video. The AI boom that has been the primary driver of equity market gains since 2023 depends, at the margin, on cheap capital to finance the placing the QCA-IDWA divergence and the broader statistical reliability question within the framework this series has built produces a conclusion that is both specific and important. The entire analytical framework this series has developed across 20 videos has been built on the premise that the structural mechanisms being documented, the bond market stress, the gold accumulation, the petrodollar vulnerability, the de-dollarization trend, the fiscal dynamics, reflect genuine underlying conditions that are more severe than the official narrative acknowledges. The QCA dual data is the most direct empirical confirmation yet that this premise is correct in the specific domain of labor market statistics. If official employment figures have been overstated by 8 standard deviations, if the labor market is significantly weaker than official data suggests, then the Fed's policy decisions, the equity market's earnings growth projections, the soft landing narrative that has dominated financial media throughout 2021, 2016, and next things, and the broad sense that the American economy is resilient enough to absorb the structural stresses this series has documented have all been calibrated to a reality that does not exist as depicted. This is not a new observation in the history of financial crises. The defining characteristic of every major financial crisis in the historical record is the gap between the official statistical picture and the underlying economic reality, a gap that persists and widens until an event, a revision or a market verdict makes the gap impossible to maintain. The 2008 financial crisis was at its root a gap between the official assessment of mortgage quality and the underlying reality of borrower default risk. The Argentine crisis was a gap between official fiscal statistics and actual deficit figures. The Soviet collapse was a gap between official production statistics and actual economic capacity. The QCEW divergence is the current version of this gap. It is specific, quantified, and documented in government administrative data. And like every previous version of this gap in the historical record, it is being acknowledged gradually through the mechanism of annual benchmark revisions that slowly bring official statistics into alignment with administrative reality, rather than through the sudden comprehensive acknowledgement that the scale of the divergence would seem to require. The bond market, which has always been better than equity markets and official statistics at pricing structural economic reality, is delivering its verdict regardless. The 30-year Treasury at 5.2% is not a prediction about jobs data. It is an assessment of an